Mutual funds sahi hai. We've all heard of this line. But what are mutual funds and how do we pick them? Knowing this can make you rich. But how? Let's find out. Hi, I'm Niyu and welcome to our channel Let's Make You Rich, because getting rich isn't rocket science. Simplifying personal finance is our mission. To support us, please subscribe to our YouTube channel and press the bell icon to receive notifications. Mutual funds, sahi hai. This campaign probably got a lot of people to invest in mutual funds. And maybe mutual funds form the bulk of your investments because it's easier to invest in mutual funds as compared to individual shares. And also, investing in mutual funds is very easy nowadays because we have so many different apps through which you can invest. But where we are going wrong is we're picking stocks, mutual funds, small cases, everything based on tips or on past returns without knowing anything about what we're doing. I have a question for you. Now, what if you play PUBG without understanding any of the rules? You lose, right? Everything has a learning curve. We need to take the time out to understand what we're doing. Similarly, for mutual funds, you need to know exactly what you're doing. And for that, you need to know what the hell mutual funds are. This is why this is part 2 of a series where I decode mutual funds. I've already made part 1, which you can watch over here, with 5 simple definitions with super simple examples. Number 1, folio. We all had roll numbers in school, and most places sorted students by surname. So basically, your roll number was some form of a unique identifier. That is basically what a folio number is. It identifies you for the mutual fund. A folio number is like a bank account number. It's a unique number that identifies your mutual fund investments.
So basically what you are saying is, if I have to talk to my bank, then I have to mention my account number. I have to talk to my principal, I have to mention my roll number. Similarly, if I have to talk to my mutual fund company, I have to mention my folio number, right?
The folio number basically helps the mutual fund company to maintain a record. Each mutual fund company will give you a folio number when you make an investment. There is no limit on the number of schemes that you can own under this one folio. So you can invest in as many different schemes from one mutual fund and hold it under the same account number or the same folio number. So just like there is no rule that you have to have only one bank account with each bank, similarly there's no rule that you should have only one folio with a mutual fund. You can have multiple different folios as well. But the thing is, the more folios you have, the more times you'll have to do KYC, you'll have to keep a track of all of these folios. So ultimately, it just means more work for you. Number 2, assets under management.
आज मेरे पास बिल्डिंग है, प्रॉपर्टी है, बैंक बैलेंस है, बंगला है, गाड़ी है, क्या है तुम्हारे पास?
ये क्या है? What's the connection of this with mutual funds?
Arey, but this is what AUM means. AUM means all the assets that the mutual fund has. This includes all the money that the investors have put in, any gains on investments, and also all the cash balances. These are all the assets that the fund manager has to manage. Now, it's a fund manager's job to generate a return on all of these assets. Each scheme has their own separate AUM. So this is their gaadi, bangla, paisa. Now, why is AUM important? This is because SEBI has imposed limits on the expense ratio that a fund can charge, and this limit depends on the AUM or the fund size. As you can see in this table, as the fund value keeps increasing, the maximum expense ratio that a fund can charge keeps reducing. Now, the lower the expense ratio, the higher will be the net asset value and the higher will be the returns that you get on the mutual fund. Now, I've explained NAV and expense ratio in part 1 of mutual fund terms. You can watch it here. Number 3, benchmark. See, when you were in school, there was always this one person, this one topper against whom your marks were always compared. And that person, that Sharma ji ka beta, was a big pain in your whatever you did, you had to beat that Sharma ji ka beta. When it comes to mutual funds, the Sharma ji ka beta is the benchmark. Now, each mutual fund decides their own benchmark, but once they've decided it, the job of the fund is to keep beating the benchmark. For example, Axis Blue Chip Fund has a benchmark of Nifty 50. Matlab, it compares its performance against the top 50 companies listed on Nifty. So for a 5-year period, you can see the fund has given better returns than the benchmark. This means it has overperformed the benchmark. But in a 2-year period, the returns are almost similar to the benchmark. And in the last 1 year, the fund has significantly underperformed the benchmark. Now, this is ulta when the market falls. Suppose the Nifty 50 falls by 10%, but your mutual fund only falls by 5%, then it is overperforming the index because it's giving you a smaller loss. Now, whenever you perform better than Sharma ji ka beta, you get a lot of praise and rewards. But in case you don't perform very well, then that to pakka milti hai. Now, this is a very important criteria that you should consider when you're evaluating mutual funds.
But why is benchmark important?
Most mutual funds have a team of professionals, and their job is to research and to form a strategy and a plan so that they can give you a return that's higher than the benchmark. And that's the reason why they take this expense ratio from you. Now you tell me, if they're taking all of this expense ratio from you but they're not able to beat this benchmark and give you a superior return, then it's kind of like a waste of your money, right?
देखा आपने लापरवाही का नतीजा है।
That's why it's very important to check the benchmark for all of these mutual funds. You have to see कि for all the work that they're doing, are they able to generate a return for you? If they're able to give you a higher return, then all of this expense ratio is justified. But if they're not giving you a higher return, then you're actually wasting your money putting it in these funds. Number 4, new fund offer. We Indians love to save money, and whenever we see the word discount or offer, 30% off, 50% off, 70% off. Whenever we see all of these terms, we think, "Arey ba, we're going to get such a great deal if we put our money in this," and then we buy it without thinking. Now, did you know a similar strategy is employed by mutual funds as well? Over here, mutual funds play on your greed and make it seem like you're getting something for cheap, something that should have been expensive, but you are getting it for cheap just because you're an early investor. This is called a new fund offer, which is kind of like an IPO but for mutual funds. It's the first time a mutual fund will offer a particular scheme to the public. Generally, the offer price of an NFO is 10 rupees, which means that each unit will cost the investor only 10 rupees. Now, you're not going to get any unit for an established mutual fund for only 10 rupees. Now, because the established fund has performed well over the past multiple years, its NAV keeps increasing as the value of its assets keep increasing. That's why these units are priced higher, because the value of their assets has increased over the years. Now, the problem with an NFO is you're trusting a new team with your money. You don't know the past performance, you don't know the expense ratio, you don't know the portfolio, you know nothing. It's literally like trusting a stranger with your money. I personally think that there's no benefit to investing in NFOs, because anyway you can invest in the same fund in a few months or a year. Now, once you invest in the NFO at a later period of time, you have more information on your side. You know the expense ratio, you know the portfolio, and you can measure the fund's performance against other funds and then make an informed decision. The only time I would consider an NFO is if their objectives are interesting, or if they have done something that no other fund is doing in India right now. But if their objectives are very similar to 10 other funds, then I would rather prefer investing in an established fund than putting my money in something new. Just remember all of these points when your agent is trying to push you to invest in an NFO. Number 5, exit load. So imagine that you go to watch a movie and sometime in between you get really bored. You're not really interested in the movie. Once you get up and walk towards the exit, there's a man who stops you and says, "If you want to exit, you pay me a price." That is precisely what exit load is. It's a charge that a mutual fund charges you if you decide to exit the mutual fund before a particular time. Each mutual fund clearly displays the exit load and the time limit within which they'll charge this exit load. If you sell the investment after this time period is over, there will be no charges. Now, basically, this fee is charged to protect the investors, because if some investors keep redeeming all of their money, then the fund manager won't be able to stay invested in the assets and generate a superior return. They'll have to keep selling off all of these assets to pay those investors who take out their money. Most equity funds have an exit load period of 1 year from the date of investment. But for debt mutual funds, this depends on their objective or the investments that they make. For example, an overnight fund invests in instruments that redeem the next day. So for these funds, there is no exit load, because you can invest your money and take it out the next day, because their assets only redeem the next day. Liquid funds have a no redemption period of 7 days. You may think that exit load doesn't matter. Kya farak padta hai? But this exit load can eat into your profits, especially because exit load is calculated on the total selling price. For example, Nippon India Income Fund charges 0.25% of sell value if the fund is sold within 15 days. So in this example, we invested 10,000 rupees, and on the sell date, we earned a gross profit of 26 rupees. But the exit charges are 25 rupees. So our net profit is just 1 rupee. So what's the point of investing? Example number 2. Axis Blue Chip Fund, which is an equity mutual fund, charges an exit load of 1% if it's sold before 365 days or 1 year. Over here, the gross profit is 4,600 rupees, but the exit charges are 146 rupees. That's why the net profit is 4,400. So here, because you've invested for 1 year, the exit load and the impact is not a lot. Example number 3. Mirae Asset Short-Term Fund charges an exit load of 0.25% on sell value if the fund is sold before 30 days. Okay, so if you invested 10,000 rupees in this fund and you sold it within 30 days, your gross profit was 16 rupees, but the exit charges are 25 rupees and your net profit is minus 9 rupees. That means you've actually made a loss if you redeem this investment before the exit load period. The idea of telling you about exit load is so that you can plan your investments. Now, if you want to redeem your investments in a very short period, then you can make investments accordingly. For example, if you want to invest in a mutual fund and withdraw it within a very short period of time, there are mutual funds that will allow you to do that without any charges. For example, there are money market funds which don't charge an exit load if you stay invested for more than 3 days. So if you need your money in a week, you can put your money in a money market mutual fund instead of putting it in an equity fund or any other fund that will eat into your profits. Now, what about exit load on SIPs? That's a very important point that most of us tend to forget. Let's take an example. Let's assume you start an SIP of 1000 rupees in an equity mutual fund. Now, equity funds will charge you an exit load of 1% if you exit the investment before 365 days. So, at the end of 12 months, you have invested around 12,000 rupees in this equity fund. So, in the second year in the month of January, if you want to withdraw your investment, only the first installment has completed 365 days. The rest 11 installments have not. And that's why an exit load will be charged on all of these other SIPs as well. If you want to avoid exit load, plan your investments accordingly.
So Niyu, what did we learn today?
We learned about a folio number, which is like a bank account number. We learned about the AUM, which is the total value of assets that a mutual fund has. We learned about the benchmark, which is the Sharma-Chi ka beta for each fund. We learned about an NFO, which is like an IPO for mutual funds. We learned about exit load, which is a charge that we have to pay if we sell a mutual fund prematurely. These terms may sound very technical and nobody expects you to know them all the time. But once you learn all of these terms and you know what they mean, you'll be able to read between the lines. You'll be able to compare two or more mutual funds and pick which fund is better. Remember, getting rich is simple because it's a process. And once you learn the process from the very beginning, you know exactly what you're getting into. And then you become bulletproof. Thank you so much for watching this video and we'll see you next week with something new.